Hello everyone and a very warm welcome to this week's stock market update for Tuesday, July the 7th, 2026. We're going to take a little different angle and a different index. This time we're going to look at the big good old semiconductors because they of course been flying high and we all want to know if the top is in or not. Well, to spoil the party, we don't think so, but we're closing into a bigger and bigger top. So we want to give you a bit of a introduction on how to properly wave count. Most people unfortunately start with a 5-minute chart and then zoom out eventually. Very few use the yearly chart. However, the Elliott Wave tracks mass sentiment. Many traders and investors are involved. And how better to measure that mass sentiment with a yearly candle chart. Every year has an tremendous amount of mass behind it. So here we count down years as corrective, up years as part of a bull. Obviously, this determines the framework for your detailed analysis when starting zooming in. You always first zoom out. Anybody who presents a 5-minute chart, I am already questioning that because there's so many ways to interpret a 5-minute chart. I barely ever go slower than a 65-minute chart. Sometimes 39 minutes kind of confirm, but that's really narrowing it down almost too much. Too many scribbles, too many interpretation issues. Yearly charts, there's barely any interpretation issue available to you because down years are corrective years. So we start here, semiconductors, 1994, up. By the way, this is, of course, I believe a logarithmic scale. It doesn't matter. Up years are part of a impulse. Down years are part of a correction. 3 down years, up, down, cycle 2. All right. I can also label it minor 2. I can label it as cup 2. I can label it as pencil 2. The name is not so important. What matters is that's a second wave low. This low was, of course, above the ultimate low here, 1994. And then we start moving higher. Okay. So we have 2 up years. 2011 was a down year. It's corrective, 2. Then we have up, a down year, 1, 2, up, down year, 3, 4. No overlap with 1. So we must assume that is a 4th wave. And then we have 3 up years and a down year in, I believe, 22. So that was 5 waves up from the 2011 low, right? 1, 2, 3, 4, 5. So now we are in this primary 5. And if we look at the wicks, we can see a clear high and a clear low in 24-25. This is the April 2025 low. Those are the tariff tantrum that the stock market went through. And now we are in this wave 3. I have it listed here on the yearly chart as complete, but of course I have way too little granularity. I essentially need to wait 1 or 2 years to be able to really add labels to it. But the main thing here is that this is the framework. This is the bull versus the bear market. Clearly in a bull market. All right. This is not so much about exact narrowing down. For that, we use smaller time frames. We should now soon be in wave 4, potential already. 5, a larger 4, and then a larger 5 before this whole bull run since 1994 is open. You really cannot critique this wave count any more than this. There's every single scribble, every single year is accounted for. And then we're going to zoom in, starting with the monthly chart. The monthly chart presents you with the trend. What is the trend? Because the trend is the friend. You can add some technical indicators, the RSI, MACD, and in this case, the Bollinger Band and some moving averages. As you can see here, price is well above its 20. I could also plot the 10-month moving average, the 5-month, and of course we have the 50 and the 200. All of them are rising, so this is a 100% bullishly chart. So we're looking out 6 to 12 months, if not longer. This is a long term. All right, so we should be wrapping up this black wave 3, potentially with some smaller 4th and 5th waves to go, somewhere around the 20,000 area before we see potentially this larger 4th wave. Okay, again, I cannot with the yearly chart yet qualify and quantify this 4th wave, but it starts to look like this, though of course we're only half a year into this year, so we have to be patient. So we should honestly label it question mark 3, question mark 4. The monthly chart suggests we still have a little bit more to go, that we're in a smaller fourth wave, and then a fifth, a larger fourth wave, then a fifth, an even larger fourth wave, and then a final 5 of 5. You look here at the MACD, no negative divergences, classic 1-2 setup, classic 3-4 setup. RSI here is making higher highs, extremely overbought at last week's high or last month's high. So some pullback to about 10,000 is absolutely normal before we can move higher again. This is the same, of course, all those years when we get these massive rallies. We'll see pullbacks. Again, that negative divergence. Look here between 16, 17, and 18, negative divergence, and you get a much larger pullback. Same here in 21. Negative divergence, much larger pullback. No negative divergence yet, so we should not expect a massive multi-month pullback, more like multi-week. And now we're going to show you the daily chart. So we're zooming in. The daily chart is, of course, structure and sometimes noise, whereas I would say the weekly chart is pure structure, rarely ever noise. So looking in for the daily chart, we can see we are in a smaller fourth wave. This smaller fourth wave, as I said, should bottom somewhere around 10,000, potentially 11,000. We have no signs of a bottom being in place. We have the warning levels for our members on the chart telling us the downside is increasingly less likely if price starts moving above it. So a move above about 14,300, that is last week's high, somewhere around there, will really mean that we have seen this wave 4 as complete. Then the first move the bears want to avoid is, of course, a break above yesterday's close, etc. So these are warning levels that objectively help us tell if the downside is complete or not. All right. So if you're short, for example, have puts in place, watch those levels. If we start breaking above it, odds start to increase that the downside is complete. The first is, of course, 20. The second is 40%, 60, 80, 100% above about 14,300. Downside is complete. Meanwhile, the MACD is rolling over, and I really want to see the MACD negative, just like we were here at late March. That is a very good sign for a sustainable bottom. Just as for the RSI 14, I want to see it close to 30, not somewhere in this middle. Same for the MACD, not in this middle. So we're right here in the ideal target zone, but no signs of a reversal yet. No signs of a bottom. So we can still go lower, and clearly support here is between 10,900 and 11,760. So look for before we can start seeing this larger fifth wave. Again, that would start to match a bit with the monthly chart, slightly different. It's okay. We can adjust it, anticipate, monitor, and adjust. That's all we can do. And of course, with the yearly chart. Last but not least, the hourly chart. This is 65 minutes. Why 65 minutes? It divides every trading session into 6 or whatever equal candles. There's 6.5 hours. So we want to make sure we get the same amount of candles. I think it's 1, 2, 3, 4, 5, 6 candles. Correct. 6 candles that are of equal length. If you do an hourly chart, your first candle will only be 30 minutes, and therefore, of course, has less weight to it because less people are involved than the next hourly chart, which is twice as long. So 65 minutes is much better for Elliott Wave because we're tracking sentiment. And again, there is, of course, less mass sentiment behind an hourly chart. How many people are involved on a 5-minute chart? Not many. It's probably high frequency computers. So you want to make sure that with the Elliott Wave, you're tracking sentiment, you're capturing sentiment. If you're not capturing sentiment, you're not doing Elliott Wave. So here for the semiconductors, we're tracking potential 5 waves lower. It could have bottomed today, but we have no signs that that bottom is complete. Again, we have our warning levels to tell that the bottom is complete. That's something else. So with this, the hourly chart, you can fine tune the daily chart. You get tuning and precision, but it requires a constant change because the more you zoom in, the more variable the market becomes. A 5-minute chart is near chaotic. Okay, and out of this chaos, order is created. So from this hourly chart, you will see the daily chart. From the daily chart, you go to the monthly, and things start to really shape up and start to make sense. Unfortunately, you will see so many people starting with this and then zoom out. You have no idea where you are. You have not applied the right hat, bearish or bullish. Clearly, the semiconductors are in a bull market. So clearly, you should have a corrective wave count as the semiconductors go lower. And clearly, it means that once this correction is over, we're going to go to new highs. Okay? Whatever anybody says, we are still in a full-blown bull market. And if it's, as long as it's in a full-blown bull market, warning levels haven't been broken, we must apply a bullish wave count that tells us, all right, we're still corrective price action. And it sure looks that way. It's overlapping instead of impulsive. So the semiconductors are in a multi-week fourth wave correction. And after 4 comes 5. We expect new highs. The yearly chart is still very bullish. The monthly chart is still very bullish. The daily chart is neutral to bearish. And the hourly chart, as we said, is just for fine-tuning and precision. It's more random, chaotic price that helps us fine-tune where we can expect a low on the daily. So we hopefully start to see some positive divergences develop, etc. With that, thank you so much for listening. Like and subscribe, and especially subscribe to our daily newsletter, because this is the stuff that most people miss. This is the stuff you really need to be successful in the markets. Take care. Trade safe. See you all next week.